We've got telco reporting season actually kicking off this week, so I wanted to run through the sector and a few key thematics and then into the key picks in there. So today we've actually got the NBN releasing their first half result. Tomorrow we've got Megaport, and on Thursday Telstra, so I'll talk through them in order. Just a reminder that late last year we upgraded our sector view from neutral to overweight. The key reason being we think we're definitely through the worst of it in terms of margin pressure and just competition overall in the sector. This chart in front of you, the blue line that's getting bigger and bigger is the NBN Active Household. So effectively, as we've rolled through the NBN, the profits telcos make on the fixed line subscribers has basically dropped to about a third of what it used to be. So we're through the most of this now. What you can see there is that right now 90% of the NBN is actually built and 80% of households are on it. We've still got to cycle the full 12 months of that, but the point is that we're through the vast majority of this highly competitive environment that is the NBN's once-in-a-lifetime forced churn event. These charts here you may have seen from me before. I've just thrown them all onto the one page, which is retail prices. So the chart on the left is NBN, the average of all the NBN plans in the market in Australia, and the two charts on the right are post-paid mobile and prepaid mobile pricing. And the key thing you'll see through all of those charts is that the rate of pricing decline has stabilised. In fact, on the NBN side, it's gone up. So telcos are actually charging more now than they were, say, 6 or 12 months ago. Mobile continues to have a bit of pressure coming through, but that's largely a function of price deflation. So that rate is quite a healthy rate. So the key thing here is mobile and fixed account for about 80% of profit across the sector, 80% of EBITDA, that is. Prices have been coming down for the last few years and they're starting to stabilise and go up now, which is why we moved from a neutral to an overweight view on the sector. If we kick into some of these results, you've already seen the Megaport result. The quarterly came out in January, so we know revenue, cash flow, and sort of the KPIs there. So we can't see anything really that's going to disappoint heading into this result, given we know everything, or at least everything that could disappoint. So the key focus here is really going to be on how they're going in North America and also Japan, where they opened a whole new region just recently. So looking to see how that's going. I think, though, for Megaport, more importantly than the results, I know that's dangerous to say, but more importantly than the result, it's a high likelihood of ending up in the ASX 200 March rebalance. So we think you've seen a fair amount of buying support and likely to see some more if that happens. And if that happens, it would likely get announced in February. So that's why it's one of our key catalysts for this reporting season. On to Telstra, who reports on Thursday. Really, for Telstra and the whole sector, we've got a massive event, which is potentially this week, which is the High Court's ruling on whether or not TPG and Vodafone can merge. That's the second major catalyst in the sector to reset the competitive environment. Hard to say, but our view is it's likely to be allowed because the ACCC's tried to block this merger, taking a view that TPG might become a meaningful mobile player sometime in the future. And from my understanding, they've got to take a view on where everything sits now, what may or may not happen in the future. I think that either which way, it's a positive for Telstra in the short term because, more importantly, we know where we stand from a competitive environment. If the two do merge, clearly it's one of the biggest mergers in telco history in Australia, and they'll be very, very much focused on integrating the business. So I don't think they're going to be really aggressive in the market initially. They've got a lot of work they would need to do. Hence, in the short term, I think it's a positive. For Telstra, we think guidance will be reiterated here. Telstra talk about that transacting minimum monthly commitment. That's just the pricing charts that I've been tracking for years, and we expect that to continue to track higher, but it does take time to cycle through. And I guess the other two things we're focused on are the cost out story that they've talked about. And as I said, that the ARPU or the pricing expansion, if prices go up and nothing else changes, then you'll see margin expansion coming through just by repricing the 4G and the fixed line side of things, but coming through in FY21. So we expect in FY21 EBITDA from mobile to return to growth for the first time. Part of that is also the 5G cycle. As you'll see, we think you'll see Telstra add more customers because they've got a superior network and also be able to charge more for it. So there are our two key buys heading into reporting season. Just a couple of noteworthy stocks as well that we've talked about a little bit. We've got Over the Wire. This is a company that's a great small cap company that's delivered really strong double-digit organic growth. Last year, they sort of started with expectations for 20% organic growth and stabilised down to about 15. So market got a little bit disappointed that it was only 15, not 20% organic growth. This year, we think if they maintain that 15% organic growth target they've got out there, the market will receive that well. So that's really the key here. This half, you're going to get an extra 4 months from some acquisitions they made over 12 months ago. So that will make the numbers look quite good optically. But we're also aware that they've materially increased their sales staff. So we're expecting OPEX to jump a little bit there due to more sales staff, which obviously drives growth in the outer years. Finally, Opticom, I just thought I'd mention as well, they've got a result out on the 20th. You can see they're coming in to talk to us the same day. They've got guidance, which they reiterated last week, effectively at an Investor Day. We do think you'll see slightly less EBITDA in the first half, so we're looking for a 46% EBITDA skew, just given they're doing more MDU or high-rise multi-dwelling units, which have a lower revenue contribution. So be conscious of that one, but we're still very comfortable with that story. And two others I thought I really should mention. Superloop, which we're getting a lot of questions from the network on. As far as I'm aware, nothing has changed. Guidance is still on track. We're forecasting this company to do 4 million EBITDA in the first half and about 10 in the second half. So it is a big second half skew story. So I think heading into the result, people will want to see them, A, reiterate guidance. Well, actually, that's really just it, reiterate guidance and hit that 4 million and show that they can get to 10 in the second half. But I think it's really a second half club, which some people will be a little bit nervous about. But in terms of the actual business, we're expecting them to finish the bulk of their CapEx spend, which you'll see negative free cash flow in the first half before moving to positive in the second half. And just the line in the sand, from a valuation perspective, if you attribute zero value to all the customer bases they've acquired, the actual network they've built is worth around 77 cents per share. I also wanted to touch on NextDC. It's one that we upgraded to an ad about 6 months ago, and it's had a really strong rally heading into this result. I expect they will reiterate guidance, but I do think there's a chance that the megawatts they contract disappoint. So I think it'll be broadly flat, mainly because they've got a big wholesale customer that's come out of contract in Melbourne. The net outcome will actually be a better outcome, which is that they can then sell some of that capacity to their retail channel where they make stronger returns. So it's actually a good outcome, but optically you might just see it disappoint a little bit on the megawatts contracted at this result. But that said, I think if that happens and it comes off much, it's a buying opportunity. Key reason being in June of this year, for the first time, everything's lined up with NextDC, which could create some corporate appeal. So they've got a number of bonds. They can all actually be bought out in June of this year. So number one, that's expensive debt. So most likely scenario is that NextDC can replace that with cheaper debt, and you'll get some an uplift there on the earnings in the next year. But also, if that doesn't happen, I also think there's corporate appeal here, because you could see someone buy NextDC, because this time you can get the land, the buildings, the equity and the debt in one go. And we've seen a heap of corporate activity in the data centre space. And NextDC certainly has an impressive footprint, a great business model, and their key challenge is just filling the facilities they've got. We've just seen in the last week someone like Oracle announce that they're setting up shop in Melbourne. Google has also announced that probably 12 months ago. So I think there's a lot more activity happening in Melbourne. Melbourne really needs to move for NextDC's share price to kick from here. But if it comes back in the result, we would see that as a buying opportunity.